Hello, everyone. We hope that you're doing well and having a great evening.
Yes,
Of course, we are.
the Turner team.
Yes, and I am Kimberly Turner.
And I'm Denise Turner.
And we are so excited to be here with you today for none other than our webinar, Prepare and Evaluate Businesses for a Commercial Loan.
That's a mouthful.
I know. Listen, we didn't want to get too creative today. We just wanted to get right to it and tell you what we're going to talk about. And of course, we are the Turner team. We are realtors who are located in Missouri State. We specialize in residential and commercial real estate. And we are looking forward to helping all of you who have the goals to become commercial business owners today. We're focusing on commercial real estate. Isn't that right, Mom?
Yes. That's a good change from residential.
Yes, we love to go back and forth here. We specialize in both. Now, we work with buyers, sellers, and investors. Whether you're in Missouri or out of state, we connect with our top realtor partners, and we are glad to help you on your journey. We even start working with our clients a year out, making sure that they are ready to go.
Yes, getting their credit repaired, taking things off the report to get their scores even higher. And sometimes it takes a couple of months.
Yeah, sometimes. But hey, listen, we're in it for the long haul. And with our commercial clients, we even help you get your business plan in order starting from the very beginning. So listen, tonight is going to be awesome because you're going to learn if you're a business owner or you have goals to become a business owner, what to do, right? How to prepare for your commercial loan in the future. And we're really excited to have our special guest tonight.
Yes, we have Roderick Nash.
Oh, yes, Roderick Nash.
And he is
the CEO and senior mortgage banker with Rockgate
Financial Services.
There we go. You see how the mother and daughter team, we work with one another to finish the sentences there. We have a good time. So we're going to have a really extensive conversation about how to prepare and also how to evaluate businesses that you look and seek to purchase for a commercial loan. So take the time now. Go ahead and make sure you share this video out, like our page, follow us on Facebook, and subscribe to our YouTube channel. And be sure to register. You'll see the QR code throughout the evening. All right. So without further ado, let us welcome Roderick Nash.
Hello, ladies. How you doing?
Hey, hi, Roderick. How are you?
Good to see you both again. Very much.
Yes. It's so good to see you too. We're looking forward to our conversation tonight.
Same
yes,
here.
There's a lot to cover, and Roderick has the answers. So
I'll try to have them.
yes, you do. And hey, Roderick, go ahead and tell the people a little bit about yourself.
Sure. Thank you very much.
Yes.
Again, my name is Roderick Nash. Senior mortgage banker at Rockgate Financial Services. Rockgate is a company that I built back in 2015. I built Rockgate on the purpose of allowing or having people have other means of being able to finance their commercial projects. A lot of times, a lot of your big banks are they want the traditional documentation and don't really think out of the box. Well, Rockgate is a company that was structured so that you had other avenues. You could actually do things that the traditional bank was not going to allow you to do, and to be able to get it done at a decent interest rate and decent fees also. We've helped a lot of people out from buying car washes, our churches, our schools, from you name it, we have done it. Apartment complexes, fix and flip. If you're an investor, we've done just about every kind of loan out there, and we would love to help you accomplish your goal to getting your loan also. So if you need any sort of services for commercial lending, give me a call, and we'll be very glad to help you out. Very much so.
Yes, Roderick. That is awesome. Letting the people know who you are and what you do, right? You also specialize in residential and commercial real
Yes.
estate. So you're very well versed in the subject matter.
Been doing
And
this for over 26 years, so I hope so.
yes,
Oh,
yes.
excellent,
We
excellent.
love
Yes.
your expertise, and we go to Roderick whenever we have a question about commercial. He's the one we go to for you, our clients. And you know, let's just jump right in. Roderick, take your time and kind of go through. I'll be transparent. We're making sure that our video is live right now. So go ahead and take the time you need to answer the next question. You could be wordy because we're not live on our business page. Restream had a little technical difficulty, so we're going to
Yes.
share it out to our business page to make sure that we're live. Nonetheless, let's start our conversation tonight, right?
Okay,
So
sure.
preparing a business to get a loan. There are so many steps that one has to take in order to be prepared to get their business loan, right?
Sure. Yes.
You just can't jump in and say I want a loan right away.
No.
You have to get ready, and so part of that getting ready includes the business owner's business tax returns, right?
Yes.
What would someone need to show on their tax returns in order to be able to get a commercial loan? And then after you talk about that, Roderick, also bring your camera down just a little bit. It's cutting your face off. Business
There you
tax
go.
Sure, bud.
deduction, right? Talk
Yes.
about the benefits and the limitations that someone should consider when they're talking about their business tax returns when it comes to A and B on our questions. Talk to
Okay,
you
sure.
soon,
No
Rod.
problem, ladies. Okay. So when you're preparing your taxes, or excuse me, when you're getting ready to buy a business, let me rephrase that, and you need to provide your tax returns in most cases if you want to do what they call going full documentation. So that when you're going full documentation, you're providing your tax returns normally for the last 3 to 5 years. You're providing it depends on the kind of business you're buying. But let's say if it's an apartment complex, you want to get a rent roll, we want to get your leases, we want to provide all those and make sure that the money is there. But when you're preparing your taxes for that, you want to make sure that you're not writing off too much of your income, so that when you do qualify or do try to get qualified for a commercial loan, your income is at the fullest and highest ability that it can be. And why that's important is that we're going to look at certain factors to see whether or not you can qualify for that purchase. If you're writing off all your income, well, your income is going to be extremely low when it comes to trying to apply for that loan and getting having the debt service, meaning your debt service and your cap rate. So you want to make sure that you're basically being able to provide enough income so that you can purchase that loan and come out with a full approval. Another negative in regards to when you do your taxes is that a lot of people, when you're self-employed, you always want to give Uncle Sam as least as you can. That's why you own your own business. But you have to also weigh it out in regards to if you plan on making any purchases in the future. You want to make sure that you can cover that purchase with your income, because we're going to base that off of your income if you want to get the best terms, the best rate, and the best fees. If you don't care about that, then there's other options that we do have that you can use. Basically, there's still what they call stated income programs out there, or bank statement programs out there, even a profit and loss statement program out there. But your best terms for rates and fees is going to be a full doc loan where you provide your tax returns for the last 3 and 5 years. So if you're going to go that route, route, make sure you don't write off all your income, because it's extremely important that we have enough income to qualify you for that purchase that you're trying to make.
Yes,
Yes,
Rod.
that's great. So, can you tell us? You said something about you want to show the most profit. That's referring to the deductions that a business owner would take at
Yes.
the end of the year. So, how does that affect his ability to buy or
So
to get a
let's
loan?
Sure. So let's say a person has been self-employed for, let's say, 5 years. And for the prior 2 to 3 years, they've rolled off as much of their income as they possibly could, so that they don't have to pay as much in taxes, income taxes. Well, when we look at that income, when we look at the tax returns, that's going to definitely affect whether or not we can approve that loan or not. So if let's say you have a gross income, let's say of $1 million, okay, you brought in for receipts for that year, but your net income after all that is going to be, say, 40,000, and you're trying to buy a building that's, say, $500,000. Well, when you look at the income that you're bringing in, that building is not going to sustain that building's purchase or your monthly payments on that purchase. Excuse me. So because of all the write-offs, we can't add anything back. We have to go by that net income plus whatever we can add back on to it. A lot of times, because of the different write-offs that you have, we can't add a lot of those back to it. There are a few things we can, but for the most part, a lot of it we can't add back to it.
Yes, so I guess you shouldn't take every single deduction because you'll end up with a zero net.
Yeah, you don't
I,
want that. If you plan on expanding, you definitely want to leave some money on the table. You got to,
yeah,
have the ability to have the flexibility to do more if you wish to do that.
yes. So we have to keep that in mind when
Yes.
we're doing our tax returns.
And
Now,
that's
no, go ahead,
and that's
Kimberly.
something that comes up quite often, I feel, with clients, that they seek to get a loan, but they don't want to pay taxes, and they, don't do what you have just suggested that they do. So I think it is so important to make sure that you take heed to what Roderick has just said, right? And prepare now. Make sure your CPA knows that you're going to want to have a loan maybe in the next 2 years or next year, whatever the case is. So let's not, do your best, CPA, but make sure you also prepare me, right, as a business owner to be able to move forward and expand on my business. So I think that's awesome, Roderick. Thanks so much for sharing that. And, talking a little bit about how you assess as a lender, as a commercial lender with Rockgate Financial Services. How do you assess someone's ability to pay their debt off, right? So that's called debt service.
Correct.
Explain what debt service is, as well as what are those factors that you're considering when someone is seeking a loan as it relates to them being able to pay the loan off.
Sure. Thank you again. Debt service is basically the coverage ratio measure to be able to see the person has the ability to repay a loan back. It is basically measured by the person's sustainability of that debt. So to calculate a debt service, you would be looking at your annual operating income by the total debt service, the operating income of the amount realized by the company and deducted by the business expenses, including your wages, utilities, your cost of goods, such as that, your depreciation, tax amortization. And basically you do use that based off of your income and then divide that, and that's what your debt service will be. You normally want to look at a debt service of about, most lenders, should I say, about 1 to 1.2%. And if you're at 1.2, I say 1.2 is about your safe bet right now. A lot of lenders increased it since the rates have gone up earlier in this year. So before you could get away with a 1% debt service, but to be on the safe side, try to be at around 1.2%.
Oh,
Yes,
okay.
yes,
Well,
yes, Roderick. And
no, I just wanted to say, that's great. How to prepare your taxes, what you're looking for in order to service the debt. And then, is it necessary for the person applying for a loan to have um, tons of cash in the bank?
It's always good to have cash. Cash is,
But
no
is it
matter what you do, if you got
necessary?
cash, then that definitely makes a big difference. When
How
we do
much?
a commercial loan, we're not looking or should I say, we're definitely not wanting you to have you spend all your money. So if you've got $100,000 in the bank, you're trying to purchase a building, and we're going to take all that $100,000. Most lenders are not going to want that. They're going to want to see that you've got some operating expenses to have afterwards too. So you want to make sure you've got your money for the down payment. You got your money for your closing costs. But you also want to make sure you got money for operating expenses too, because we want to make sure that you're in business 6 months down the road, a year down the road, 2 years down the road, etc. And if we're cleaning you out just to get that purchase done, then we're not doing you any good or ourselves any good.
Yes, yes. And talk a little bit about how you evaluate as a lender the income that a business has, right? The profit, the loss, to determine the net income, right? Explain what that is on a one-on-one basis, right? What's the gross, the net, the profit, and talk a little bit about that as it relates to debt service when you're considering that.
So your gross income is basically all the proceeds that you received during your transaction, okay, for that year. So let's say you've got a gas station and you had total receipts of, let's say, $2 million for that entire year. Well, after all your deductions, which would include your labor costs, your utility costs, you would be looking at any sort of maintenance that you would have to have. There's a lot of different factors that include in your debts. Like I said, your healthcare bills, stuff like that. All that would be part of your debts. Your debt service would be your gross income divided by all your expenses, and then your net income would be what the remaining is, and that would be what we classify as your net income after you've paid everything off. Once you've got that calculated, then we use that number to determine if we can get you another loan. We're going to use it based off the net, not off the gross.
Awesome. We're still trying to help here with the business page. We're gonna just share it to our business page here in a moment. If we don't get it, Restream is having technical difficulties, but nonetheless, thank you for explaining that and talk a little bit about the risk factor, right? How you are assessing risk when it relates to a buyer being able to pay off their debt, right? What's the risk factor in the analysis?
That's why we look again at the debt service or your cap rate. And we make sure that you are within a certain parameter that the bank feels comfortable. So if you're under, as I said earlier about the debt service being at 1.2% or less, most lenders are not going to want to take that risk because they feel like you're too risky then. If you're over that 1.2%, then they're going to be a lot quicker to do that. And the higher you are over that debt service number that they require, the better and more likely that you're going to get that loan approved. So let's say if you've got a debt service of, say, 3.2%, most lenders should jump on that loan and qualify you to get you approved. But you got to make sure you're managing your money and you're managing your situation and you're in control of your business and your business is not controlling you.
Yes, and it really takes a lot of planning and organizing,
yes,
and I guess consulting not only with you but with a
financial advisor.
Yeah, because this is serious business, especially when. Yes, because the next thing I wanted to know, sometimes people leverage their assets in order to buy a commercial property. Now explain that, because to me that sounds like a lot of risk on the buyer's part.
But we know our buyers do it all the time.
Yes,
I get it every day.
So we're just speaking right now as someone who doesn't know about it, right? So talk to the viewers, let them know, what does leveraging assets to buy a commercial property mean? And, talk about that first, and then when would they want to do that, right? Because it seems risky, like my mother said, but it's something that happens all the time.
All the time in business. Yeah.
So let's say you have an investment property you want to buy. And you say, well, Rod, I got this investment property. It's $100,000. I got 20% to put down on it. So you're going to leverage that 80%. So we're going to finance that 80% of that $100,000 that you're trying to buy. Your money that you receive on that rents for the investment property is what you're basically using to cover that payment. You want to make sure that whatever you're bringing in for that rent is covering your actual mortgage payment. And that's basically what it means leveraging. You're leveraging the income and everything that you're making off that property to be able to buy that property. And so as long as you can, they say you got the $100,000 property and you're making $3,000 a month rent in there, well, you're perfect on that because your house payment or your mortgage payment on there is going to probably put you somewhere around, I'd say around $900 to $800, somewhere around there. So you bring it in $3,000. Well, you're going to have a net after all that of around $2,200. So that's going to definitely put you in a good favor for us to say, yes, let's approve this loan. Now, if you're having to reach into your own pocket to cover that payment, then not so much. We're not going to be so quick to want to cover that because we want to make sure that whatever you're receiving off of those proceeds from the rent that you're collecting is going to cover that payment.
Yes, yes, that sounds very wise. But can you tell me and tell our viewers what assets, what type of assets besides a house can be leveraged?
There's all kinds of assets you can use. I've seen vehicles being used. I've even seen jewelry. I've seen farm equipment. It depends on your business, really, what you have. I've done loans where people use their actual equipment that they own, from pressing machines, it varied. I had a guy that had a warehouse that did pallets, and we used some of the equipment that he had there for his leverage. I've had schools. You name it. I had a guy that did had a lawn care service, and we used all of his lawn care equipment as part of his leverage for his monies to be able to get the loan. So it really just depends on what you have, but just about anything of value can be considered, an asset in leverage.
Awesome, awesome. So, hey, you have some expensive jewelry at home? Maybe you can turn that jewelry into a commercial business builder.
Yeah.
I
All
can't
right.
how much you're going to get per dollar on that.
Now it just depends on how expensive that jewelry is.
That's you're going to praise by a professional and everything, but yes,
That's right. You have to get all the right things done for sure.
Documents, yes.
For sure. So, Roderick, let's talk a little bit about new versus old, right? We know new school versus old school, but new business versus old business. When it relates to how a borrower can have a loan, right? Can receive a commercial loan. So, here's a question. Someone starts their business a month ago and they come to you and they come to us and they say, I'd like to get a loan. I want to get some space for a business. And we say, okay, great. Let's send you over to our lender, Roderick and Ash, right? And they come to you and they say, I'm looking for a loan. They've started this business just a month ago. What are you going to say to them, Rod? Can they?
Yeah, it's going to be very tough. It's going to be very, very tough. If you're just been in business for a month and you don't have enough time under your belt, really, to convince most lenders to take a chance on you. And also, I guess it really also depends on the type of loan that you're trying to get. So if you've got some sort of other collateral that you can use to help support that loan, then we might reconsider that. But if it's just, hey, I've been in business for a month and I need another $100,000 to expand my business, in most cases, just to be honest with you, it more likely won't happen because they want to see that you've got about 2 to 3 years history up under your belt. But again, it does have a lot to do with the kind of business that you're owning, though, that you're trying to operate. So I've seen it where you can have a gas station or something like that where you need inventory. Well, you can sometimes get loans based off of your inventory and use that. But in most cases, though, other than the gas station or something like that where you have to have inventory, it's going to be very tough to get a loan when you've just been in business for about a month.
Yes. So
Yes.
you have to have a track record. You have to
Yeah,
have
you
some
want to see that
history.
you're successful. Yes,
Yeah.
commercial business in some ways is easier, but in other ways it's kind of tough because it depends on which side of that commercial loan that you're looking at. If you're looking at your traditional banking, they're going to be a lot stricter. They're going to dot all their I's, cross all their T's, and make sure that you're doing everything that they want to see. And they're going to be extremely conservative. Now, if you go with a brokerage or you go with a private lender, they're going to be more apt to take more risk and do more things. But you're also going to be paying more money for that loan. You're going to be paying a higher interest rate. But there are means out there to where you can get the monies regardless of going through traditional banking. So that's where going with someone like me as a broker, I have all those different varieties for you.
Yes.
And you mentioned interest rate. Are commercial loans and residential loans, are they on the same track as far as inflation and interest rates going up?
Well, they're similar, but then in your commercial rates are going to always be a bit higher than your residential loans. And again, it goes back to again, what lender are you using? You're using your traditional banking systems, or are you using, your non-traditional lenders? Um, right now, I'm seeing rates go from about 7.5 on the good side, on the A paper side, and I'm seeing them go all the way up to. I've seen some almost 20%ers on the personal or no, excuse me, on the private lender side. So it
Mhm.
really depends on what you're trying to do. But they are affiliated with Prime, but then you're going to have Prime plus whatever, again
Right.
depending on what type of project you're trying to do. But if you're looking at A paper as we sit right now, you're looking around 7.5 on the A paper side for a commercial lender. Just again, that's going full doc. You're showing all your income. You did not write off a bunch of stuff in your taxes and everything, and you're showing back the last 3 to 5 years of your income, and you've got all your ducks in a row. You're going to likely get a 7.5. I say 7 to 7.5 interest rate. And if you don't have those things available, then that's where you start looking at maybe thinking out of the box and going something with a little bit higher rate, but you're still able to get that loan.
Yes, yes. And I want to make sure that our viewers understand when you said 20% interest rate, you're talking about a private investor, right?
Yeah, yes, yes.
You're
You're
not
not going to
talking
get that. No,
we're not talking about, going to a bank. We're talking about an investor who decides, how can they further their growth of their money, right?
Exactly.
By investing in someone who's having difficulty receiving traditional forms
Exactly.
of financing. And so that's why they hike it up, right? We're
Because
not
they
really about,
can't.
utilizing private investors unless it's absolutely necessary. We will help you get to where you need to be so you can have that 7.5. Stay around the average rate for commercial and working with Roderick, right? And a commercial lender with a bank. So,
Now, I'll
all
tell you
right.
one thing that everyone's story is different. And so
Yes.
not everyone can go to your traditional banks. And so that's
That's
why,
right.
again, it's very important to know what your options are. Because you may not fit into the traditional banks, guidelines, but you may have the down payment and you may have the credit scores, or you may have, the business plan, you got everything that you want, but you don't fit that traditional bank guidelines. Again, there's nothing wrong with going out and using other lenders that aren't your traditional paper lender, because you're still going to accomplish what you want. You can always go and do a refinance after a couple of years of once you got your business established, you've proven yourself. Then we would love to come back and go to a traditional lender and go from maybe a 12% rate down to a 7.5% rate. But the bottom line is you can still accomplish your goal regardless of whether you want to go full doc or you want to go alternative doc.
Right. And the main thing that I pull from what you said for us, right, as a Turner team in protecting our clients, right, is that you understand, right? You understand these options. You understand that this is a very high interest rate, but if you just like, I have to do this right now, then it is an option. However, we can help you get to where you need to be, right, as a business owner so that you can utilize a lower interest rate, which means a lower monthly payment, right, overall, but you have the option and you can refinance. But we're more for get you ready to where you need to be, right, with the Turner team. But other people, right, you may decide to just go straight for the private because that's what's available. And if our clients want to do that, we will support you,
Yes.
but we want to advocate that you use the most economical, right, loan possible. And I know Roderick works with a lot of private lenders, so Roderick has a different point of view. So we may disagree and agree to disagree,
Well,
and that's all right. That's
I've got other, again, you have A lenders, you have your BC lenders, you have your DE lenders, then you have your private lenders. So you have different ranges of lenders. Back in the
yes,
day, before the market crash in 2008, 2009, used to have what they call the subprime market. So where somebody may not have been able to qualify as an FHA or conventional loan, the subprime market gave them the ability to still buy a house. Well, those loans or those type of programs are still available on the commercial side. So
yes,
even though you may not get the A
yes.
paper, you still got BC lenders they're not private lenders. These are just regular lenders that are saying, okay, we've got easier guideline requirements to allow you to be able to get the loan, but at a little bit higher interest rate. You're not going to be at the 20. You may be at maybe 8.5, 9.5, somewhere
Mid,
around.
right. Yeah, yes, and that's a little better,
I don't want to scare
right?
anybody off. I just want to make sure they understand because it's not just from a paper to to private lenders. There's a lot in between there, and I've
That's
got over
right.
And
300 lenders that I work with.
and and then sometimes you just have to do what you have to do.
Yes,
Yes.
So
yes.
yes, but always check and recheck and make sure you're making the right decision.
That's right. That's the main thing. And so, back to the new school versus old school, right? So, let's say on the other hand, a business owner, has been in business for some time, right? And so they've been in business at least 2 or 3 years.
Hmm.
And they are looking to now purchase either the same similar business, so a building that houses a similar business as theirs. Let's say they own a barbershop,
Okay.
right? And they're looking to buy a building that also housed previously a barber shop, right? So it has all the fixtures and things that you need inside of that building already. And this business has been operating for at least 5 years, the one that they're going to buy. And so they're looking to do that. How is that scenario different from someone who owns a barbershop, also been operating that business for the same amount of time, right? But they're looking to buy a building that is vacant, that has not housed a barbershop. Maybe it was
strip
a
mall.
boutique, right? A boutique, or a strip mall, and they're going to utilize one of the units for their barbershop. How would their process on either
Differ.
ends differ?
Okay. The experience definitely helps out by both avenues. So they both got a barbershop. They've been running the barbershop. We're going to look at the last 5 years of their experience and whether or not they've been making money or losing money. If they've been making money, that's a big, big plus. And we look at the first scenario that you gave in regards to buying another property that was another barber shop. We would like to take a look at their tax returns for the last prior 3 years to see if they've been successful or not. If they haven't been successful, it does not mean that that the new buyer cannot get that property. We're going to then look at again what their experience has been with owning a barber shop. If they've been successful, then we're still going to, more than likely want to move forward that loan as long as they can meet the debt service on that loan. And when you have an existing business, we're going to look at what they brought in on the proceeds, but we'll still evaluate what your current business is doing too. And we know that those are two separate things. So your success with your current business will have a lot to do with whether or not you can buy the current barbershop or the new barbershop that's in existence. As for buying a property that is not a barbershop, totally separate building, like you said, a strip mall or something, we're going to look at your history, but we're going to also evaluate what you're collecting on the rents on the strip mall. Okay. And so the strip mall, let's say if it's a 10-unit strip mall and you're making, say, $10,000 a month off of that. Okay. And you're buying it for, let's say, $500,000. Again, we're going to look at your debt service on that and your cap rate. And if you've got a good debt service, again, around 1.2, regardless of what your business, we're going to evaluate that, but that other business stands by itself. And so, as long as the rents that he's receiving off of that can maintain itself, then we'll get that loan done. Now, we also can still look at what you're doing on your own personal business. If that's the debt service isn't there, you're not making the monies off of the necessary rents there. But you say, hey, I've got a business plan. I'm going to make some improvements on the property. I project that after I've got everything updated on the property, I can turn my rents around from $10,000 a month up to $15,000 a month. Well, that's going to make you look a lot better, and we're still going to more likely say, okay, let's get the deal done.
Yes. So, in short, you analyze, right, whether or not it's going to be a similar business that you're purchasing, because the buyer is going to be purchasing the business, the land, right, and also purchasing the building.
Yes.
Right. So those are the three that you're purchasing as a commercial purchase. So when they're buying a business that's similar to theirs, you're going to look at their history as a business owner themselves, the buyer, client, right? Our client. And then you're going to look at the similar business, right? Their history.
The sellers.
That's right.
Yeah.
The seller's history. When it's
now, even though the seller may not be as successful, as long as you're successful and you're showing a positive, income year after year after year, well, we're going to have more faith in you that you can maybe take over that next business and be successful with that also.
Yes. And if the seller is successful,
Mhm.
then how does that work?
It's
That works in their
better.
benefit.
It's better.
Yeah, there you go.
The
Some
seller
sellers.
does not necessarily does not have any resorts on the final answer when it comes to us approving that loan. Okay, we want to review it to see if they're making money, but it's really the person that's buying it that we're really leaning on. Okay, we want to make
That's
sure
right.
that they've got the experience, or if they don't have the experience, they've got a good business plan to show that, hey, we're going to turn this thing around and make this work. There's a lot of times where I've done loans for people that weren't in the business at all. They bought an existing business, but they came and put together a good business plan. They had good reserves left over, and they had good credit scores, and we were able to make the deal happen. So
Yes.
the seller's information matters, but is not detrimental.
Yes, yes. And then on the other examples, that was A, and then B was a barbershop owner who's been in business, right? And they're buying maybe a strip mall, right? And they're going to utilize one of the units in the strip mall for their business. And the strip mall is already, maybe 80% occupied.
Mm-hmm.
And in that instance, you're going to also still look at our buyer client's
Yes.
history, right? And then you're going to look at the seller's rental income to
Mm-hmm.
analyze their rental income. And if they had a barbershop, maybe in one of the units that the buyer client is going to utilize as their barbershop, then you would look at maybe that analysis as well. And you're able to put together this picture of what the buyer will be able to do, how they will be able to manage their business and service their debt.
Yes.
Would that sum it up?
Yes, it would very, very much so. But
Okay.
now is one other thing I'd like to interject on. If they're going to have their business, in that strip mall, then it's what they call owner occupied, which is a good thing. They're going to want to see that. You can go both routes. You can not own a business in there and own the land or own the property itself and not have a business in there, and that's called a non-owner occupied property. But you can also have a business in there and be owner occupied, even though it's 10 units, you're still occupying one of the units. In most cases, most lenders will like that in a lot of cases because you're operating your business out of that strip mall too. But again, they're going to look at also the overall rents that you're collecting overall to combine to see whether or not you can meet that debt service and that cap rate. As long as you've got that, you shouldn't have any problems.
Yes, yes. Now listen, I don't know if we explained what cap rate is. I know we've been utilizing the terminology, but talk to the people. Just tell them real quickly here the substance of what a cap rate is, right? Because we use these terminologies and we throw them around, and it makes sense to us. But somebody may be asking, well, what's a cap rate?
Well, your cap rate basically is going to be a lot of your expenses that you have divided by what your cost is. And so your cap rate, or excuse me, what your return is, excuse me, they want to see that you've got a good cap rate on your property. There's so many different ways to calculate a cap rate, and it's just kind of really depends on the type of property that you're trying to buy. So it's kind of, it's a vague number in a way, because it really depends on what you're trying to do and what your goal is. But your cap rate is very important, though, for us to say, okay, if you got, this is so much of a return, you got to say a cap rate. Let me give you an example. I've got a deal right now where it's a 38 unit apartment complex, and their cap rate on the property is about 8.5%. So that's a very good cap rate then. Okay, very, very good cap rate. So most lenders, when they see that, they're going to say, okay, yeah, we want that. We want to make a move on that. And so a bad cap rate would be something I'd say 1.2, 2.3%, somewhere around there. But if you can get, about 5 to 6% or higher on your cap rate, you should be fine.
And what does the cap rate tell you? Right? The cap rate tells you how long it's going to take
to get your money back. Yes, I'm sorry.
Yes. That's all right. It's second nature to you. I understand. It tells you how long it's going to take to get your investment back, right? When you use that percentage, because that's how much you're going to pay back, right? Explain a little bit about that.
Well, again, that's going to be like the time frame that you will take for you to recoup your costs to purchase the property. And so let's say if you got a cap rate of 7%, then they figure about 7 years for you to get your money back of what you put into it. If you got a cap rate of again, it depends on what you're doing. That's the whole problem. That's why I hate trying to explain a cap rate, because each industry is different on how it's calculated and how it can affect you. But again, that's where
generally.
What's that again?
Just generally.
Yeah, well, like I said, with the guy with the strip mall with the 38 unit complex, he's going to get all his money back within 8 years, 8.5 years. That's not bad.
That's awesome, right?
So, and that is a what was the purchase price? I know it was $6 million. I believe is what it was, just under $6 million. So that's
Yes.
a pretty good return.
Yes, so that's his return, right? His return on investment, on the other hand, is with, and I think we're going to get to that later, though. But that's how much money he actually put in, or she
Yes.
actually put into the deal, right?
Yeah.
The ROI. So if they put a down payment of 10%, or they put a down payment of 20%, how quickly will they get that money back? That's their
Exactly.
return on their investment. And cap rate is how quickly will they actually pay off the loan. Is that right?
Yes. Yes. Mhm.
Okay, awesome. Awesome. Yeah, we just want to just give some of these definitions here. And then, of course, Google is our best friend. So you
Yeah.
can always Google cap rate, YouTube cap rate, or hey, give us a call and we'll make sure we talk to you about what these terminologies are even further if you have more questions. So back to our example here. I'm looking at the time, and we're going to move on here in a moment. But so, you have a new business, you have an older business. Here, an example where someone, they have not owned a business, but they're purchasing a business. So, let's say maybe a car wash, right? And they're purchasing the car wash. The car wash is active, it's running, it's profitable, and this person is going to buy that business, land, business, and building, and they're going to take over. Right? And they
Mhm.
have not owned a car wash themselves before. They can still do that. And you, as a lender, you would utilize the seller's tax documents, the
Mhm.
seller's information, and then kind of to put everything together, right? You would also need them most likely to utilize SBA, right? The Small Business Administration product, so that then they can have 10% down and they can purchase that property. And
Sometimes
SBA,
everything's 10% on SBA.
say that again.
It depends not all loans are 10% down or 90% financing on
Oh,
SBA.
really?
Yes, yes.
Okay, so they
So
vary. But
yeah,
That's
it
right.
varies. Yeah. There's different types
Right.
of
But we're hoping for 10%, right? We just had a deal like this, right? So 10% down, and they may have to leverage, right? They may have to leverage, like what we just talked about. Leverage their home or leverage life insurance or leverage whatever the case may be so that they can go ahead and purchase that business. So I say all that to say, if you have not owned a business before, but you're purchasing a profitable good business, right? We just closed on one recently with a millennial who purchased their first commercial property, right? And they were able to utilize the information of the seller and do other things to be able to purchase that property utilizing an SBA loan. So it's not always 10%, but that's what we're always shooting for. Right, Ron? Talk a little bit about that.
SBA though. That's they're going to normally want to be owner occupied to get up to that 90%. And again, it depends on the type of business that they're trying to buy also. So like you can't
Yes.
do a 90% on an apartment complex with SBA. You couldn't do that. But if you did let's say you had a grocery store or something like that, you might be able to do 90% on that then.
Yes.
But the
yes.
type of loans that you deal with, Rod, what's the down payment?
Average.
It's
I try to find really good lenders that can do some incredible stuff. Most your typical lender is going to be about 80%. That they'll cover and they'll make you put 20% down. That's going to be 20 to 30% down. What your average lender is going to be like. I can go up to 85% loan to value when you only need 15%, and I can do those on, let's see, from four units and up. I can do those on. Let's see what else. A lot of owner-occupied businesses I can do that on, and these are A-paper loans too, by the way. So this is not a subprime loan or anything below full doc loan. So if you've got a project that's again, excellent example. Here's another deal I've got here that's out of Springfield. The client is buying a property there, and if everything goes okay, I'll be able to get him the 85% financing, where most of the other lenders are telling him he needs 25 or 20 to 25% down. So he's loving me now because he's only have to come up with 15% of the money. It's not owner occupied either, so that's a good thing too. So that's That's another commercial building where he's going to be able to not go. He's going to have the traditional financing in regards to the rates and terms and everything, but has a really good down payment requirement.
That's
Awesome.
excellent. Yes, yes.
You
And
know,
I need to reiterate on that cap rate too, because I don't think I fully explained that. Okay, so your cap rate basically is like your gross income, basically divided by your net, or excuse me, your gross expenses, excuse me, divided by your net income, and that's how you classify your typical way of classifying your cap rate. So you take all your gross expenses divided by your net income, and that'll give you your cap rate. Sorry if I did not explain that earlier.
Okay,
that's okay.
I like
Listen,
it explained that way because
Yes.
I like equations.
you know, we're
Then you could do the math.
And that's net income.
that's the business,
That's
the
good.
business MBA degree in my mother. Not me. I leave the math to my mother, and I handle other things as an attorney. And when we come together on everything else, but yes, thank you for explaining that further, Roderick. And so, talk a little bit here about how someone would do their projections if they are a newer business as opposed to being an older business, and mix in if someone is buying a similar business or a different property. Just talk a little bit about that, maybe 30 seconds or less, and then we'll jump into appraisal, and then we'll get to our next session of questions here. And we may not get through everything. We'll have to have you back again, of course, but talk a little bit about that for now.
Okay, so your projections, let's go back to using the analogy of an apartment complex again, or a multi-unit. Let's say someone's going to buy a four-unit apartment complex or property, should I say? And they're right now collecting $1,000 a month on rent. Okay, and they're 2-bedroom units, 2 baths, say 1,000 square feet per unit. They say, okay, I've got a construction company also. I'm going to go in and I'm going to update the property. The property's kind of dated, so I'm getting $1,000 a month for rent. When I get done with updating the property, I want to bump the rents up to $1,400 a month. So those are with the improvements that you're making, your projections now say from $1,000, I'm going to go all the way up to $1,400 a month in rent. So when you take that $1,400 a month, you're normally going to be bringing $4,000 per month. So once you got the property rehabbed and you've got everything done, you're going up from $4,000 to $5,600 a month per rent. So that's with you projecting with your improvements that you're going to make to the property. You have all the improvements done. When you came to me initially, you had this all in your game plan and everything. We saw that. We saw what you were going to do. We even gave you the money to help you do the rehab on it too. So then once you're done, your projections came true because now you can bump the rents up from $1,000 to $1,400 a month. And that's basically how that works.
Oh,
Awesome. Thank you so much for explaining that.
You can do that with malls. You can do that with just about any kind of business where you're collecting a monthly rent on.
yeah. So you can project, and then you also have to take account how many units are going to be vacant
Exactly.
on average, that kind of thing as well. Yeah. Well, I don't think they have too many empty units nowadays. I hear that.
Not
When
many.
we see in our research, it looks like
No places to
people are
live
coming back.
anymore.
Yeah, people are coming back. It's a good time. It's a good time. Retail is starting to tick up a little. People are looking for space for their businesses.
And
So,
apartments.
and of course apartments and things of that nature. People need somewhere to live.
Yeah.
So it's a good time for investments, and purchase, of course. And so talk a little bit about appraisal. How is an appraisal done in commercial? It's a little different than residential because you're considering, the business, the building, and the land. Talk a little bit about that.
So on a residential appraisal, we're evaluating the house itself in regards to what the value of the property is going by in the medium and the surrounding area within normally about a 2-mile radius. It's in most cases now you're seeing a lot of these appraisers looking at about a mile, even as low as a half a mile. But they're going to look at all similar properties that are like yours in regards to square footage, bedrooms, bathrooms, etc., garages, the living space, if you got a finished basement, etc. On a commercial unit, it's quite different. They're going to base it off of the square footage and everything, and also the improvement that you've made, but also the rents that you collect off of that. So if you got let's say a 4-unit apartment complex, you're bringing in about say $5,600, $5,200 a month. month, there's a good chance your property is going to probably evaluate value, or I'll say about over $500,000, say 550,000 or so, 500,000 in that range there, because it's going to be based off of the income that it brings in, besides the overall square footage and bedrooms and bathrooms of the property. So they look at it, they look at it on the income basis of it, not just on the actual square footage and the living space and bedroom. So it's totally, they look at it on the basis of what can it bring in. So if you got exactly, so if you're making money off of it, and then that's going to determine, hey, it might probably be worth $1 million or worth $5 million. Well, if you're bringing in 500, let's say 500,000 net, on your proceeds, then there's a good chance you're right, you're going to come up quite a bit higher than if you're only doing 200,000. So that really makes a big difference on how your income, or should I say not your income, but how your property's appraised.
Awesome. And so thank you for explaining that. And, talking a little bit about, I guess, we'll talk about it a little later in another webinar, how you go in depth about, the business and how you analyze all of that. But we'll get to it a little bit here, actually. Look at me. It's actually the next thing that we're getting ready to jump into. So let's talk about evaluating, right? Evaluating a business. Okay, so when you, the lender, and the buyer are looking at documents that are presented to them by the seller. So we put an LOI, letter of intent, on a property that our client wants. After, of course, we've gone through the whole process of finding the property and all of that good stuff that we'll talk about in another webinar, right? But then we put a letter of intent. The letter of intent is, a non-binding agreement for the contract, right? A preliminary step. And so then it's agreed upon. We have the contract, right? Now we're able, either during that letter of intent stage, depending on the seller and the seller's realtor, or once we have the contract during due diligence, to receive the documents, right? Documents that, if you go back and look at our Commercial Loans 101 on the Turner Team's page, our webinar, you'll see what all of those documents are, right? And a little bit more in-depth analysis about them. But now we want to talk about, how do you evaluate those documents, right, Roderick? So documents like profit and loss statement, and when you talk about evaluating them from a lender's point of view, what is the document, right? Number one. And then how do you evaluate it? And, any information that you should share with our viewers about that document. So first, let's start with a profit and loss statement.
Okay. So a profit and loss statement is going to tell me how much income you've brought in within a certain time frame. So whether it be a month or a year, we're going to want to see that. And then that profit and loss statement is almost like a pay stub for a person that's self-employed. Where normally we ask somebody for your W-2 pay stub. Well, if someone is self-employed, they may not have that. So we'll use a profit and loss statement to determine what their income has been. When we analyze that, we're going to look at a certain time frame. So depending on when we're asking you for that, if it's, say, after the tax year and everything and stuff, and you may not have gotten all your pay stubs, then we say, okay, well, give us a year-to-date profit and loss. So from the beginning of the year till now, let's say May 9th, on today's 9th, yes, to May 9th, give us a profit and loss statement on what you brought in for your income. We're going to analyze that. We're going to look at what you made the prior years and say, okay, if you're going up or down on your income, that's going to determine whether or not we feel more comfortable or not with that loan. But basically what that does is it just gives us a better idea of how you're sitting with your finances and proceeds at that time. But it is like a pay stub for us, how we look at it.
Yes. So Rod, how many years do you look at?
It depends on the deal. I've got some loans where I can go just strictly based off the profit and loss and not look at your tax returns at all. So again, like I said, I've got other lenders, not just your typical A lender, but your B and C lenders also that will just say, okay, we'll look at just that and not look at your tax returns. On those, we can go back 3 years if you don't have one, or even a year. Just go back 1 year. If you don't have your tax returns, then you'll say, okay, we'll go back 3 years in your profit and loss statement. Make sure it's certified by an accountant, and we're good to go. A lot of profit and loss statements, individual can make them themselves. But when we do a loan, we would like to have it normally by an accountant that's reviewed it.
Yes, yes, awesome. And talking about how you view their income. So then that brings up some terminology that we touched on earlier, but just briefly breeze through it. So you're looking at their gross income,
Yes.
right? Gross
Gross
income
income.
is, go ahead. Gross
Yes.
income is,
Oh, I'm sorry. Gross income is all your income that you brought in uh, uh, before you before you took out your expenses. So I'd say I had total receipts of $100,000 for this month. Well, after all my expenses and my salaries and everything else I paid out and expenses of the building, I may net only 20,000 of that. Okay, so my
and net is taking
that
your
is
expenses out the
exactly what I
gross.
actually made after I paid everything out. That's what I actually brought home. So that's the difference. So gross is like when Uncle Sam, you have your gross income when you file your taxes, even as a W-2, and you say, well, I made $80,000. Well, then when you look at what Uncle Sam took out and everything, well, that 80,000 now $40,000, or $60,000. So that's your net income. So it's the same
That's
thing applies
right.
on the commercial side also.
Yes,
Yeah.
and that would be on their profit and loss statement, right?
Yes.
You would be able to tell that information. And then further, we talked about in depth already cap rate. So you'll be able to analyze the cap rate by doing the equation that we discussed earlier, right? And then you'll be able to also take a look and see what the return on their investment may be, which we also already talked about earlier. So just rewind the video, and you'll
And
be able to
debt
see it,
service.
right? And debt service. So we've covered the profit and loss statement. And of course, when you have more questions, you want to know before you go. So go ahead and register for the webinar. This way we can reach out to you and you'll be able to connect with Roderick Nash, right? With Rockgate Financial Services so that he can talk to you. We'll connect you with him as our client. You feel free to give us a call and we'll make sure we do that. So,
Yes, but wait a minute. You'll be talking directly to the CEO. And so you can go right to the top.
yes, right to the top. Okay, why not? That's just how we operate. So profit and loss statement. That's one of the documents that the buyer and you, the lender, are going to be reviewing in order to analyze whether or not this is going to be a good deal for everyone, right? And further, you're going to look at the tax returns, which
Mhm.
I think we talked about a lot in this webinar here. But talk a little bit about if the buyer's tax returns show that they are in good standing, right, with the state, good standing with paying their taxes, right? But the seller maybe not so much, or maybe the seller is in good standing. What does that mean?
The good standing is basically saying that the state is, not coming after you for monies you've owed them, and you're like you said, you're on top of your taxes and everything else, and you have not had any sort of write-ups or anything negative reflecting your business and the way you've ran your business. As long as you've got that, you're in good hands. Now, the sellers. Whether they have a letter of good standing or not does not affect the buyer. So the buyer, let's say the seller has a negative, does not have a letter of good standings. That does not prevent the buyer from still being able to buy that building. As long as that buyer's in good standings, then we're fine. But that seller, may have a problem with trying to buy another business or something like that down the road if he wants to expand or do something different outside of selling that business. But again, like I said, it does not affect the buyer. The buyer wants to be in, everyone wants to be in good standings with the state and the federal government because we don't want them coming after us. So it's always best to, be on their good side.
That's right. We want to be on the good side of the government.
Side of IRS.
That's right. That's right. Well, thank you, Roderick. And we're coming up on the end of our webinar tonight. So if you have any questions, make sure you put them in the question and answer session here in your chat box. And we'll be sure to ask it to Roderick before our show is over this evening. So some of the other documents that you're going to be looking at to analyze, we've talked about already. We got ahead of ourselves. And so we talked about rent rolls, right?
Mhm.
Rent rolls, just speak briefly about that again, Roderick, because from a lender's point of view, what are you looking for in those rent rolls to analyze if this is a good transaction?
We're looking for consistency. We want to make sure that and the rent roll is going to show us a couple of things. They're going to show us the occupancy percentage, which we want to see 85% or better on your occupancy rate on any kind of investment properties that you may have, whether it be a strip mall or maybe an apartment complex or whatever, or a multi-unit. We just want to make sure that you've got it fully, or not fully, but at least up to 85% on the capacity. The rent roll is going to tell you how much you're bringing in per unit. And the consistency of those that you're bringing in on that rent roll. Then if you have like I just give an example. I saw one just the other day where the numbers were all over the place. It just wasn't it just wasn't consistent. We see if you're seeing a $10,000 gap here, $10,000 gap there, and then it's like, okay, well, we need to explain that then. If you're collecting so much money on per unit and we're adding those numbers up and we're seeing this gap of 10,000 per month, whether it be an increase or a decrease, we're going to need that explained. We need to know where that's coming from. Is there something else that you're doing different than what you're just renting out per month? Is there something else that's causing you to have that type of gap per month on a regular basis? So we want to explain that. We want to know what that is. Other than that, the rent roll just tells us if you're consistently collecting your money and you're being profitable. As long as you're being profitable, we're good. If you're losing money, then you got a big problem. You probably need to sell really quick.
Yes.
Well, I'm sure there was a big difference and gaps all over the place during COVID, because a lot of people lost their jobs and couldn't afford to even pay their rent.
Yes.
So if a landlord, owner of a multi-unit complex, had tenants during that period that were unable to pay their rent. However, the government may have come in and subsidized him for the lost rent. How does that affect his business?
If he got subsidized, I'm sorry.
No,
if he got subsidized, the government did subsidize him after that, it's going to help him. If he did not, then he's in big trouble because it's going to bring down his value of his property. As we talked earlier about the appraisal and everything, when you're doing a cost approach on the appraisal, or income approach, excuse me, on the appraisal, if your income is lowered, from 20 and from 20 and 21, and then you look at 22 and you say, okay, well, my income was a lot lower those 2 years because of COVID. Well, that where your value was maybe $2 million for that property. Well, I'm just using round numbers right now.
Yes.
You lost 30% of your income. That's going to bring that property value down by that 30%. So it will definitely affect you. It does help if the federal government does come in and make up for it, but only to a degree. It doesn't really help it out if it's still, as long as it's still rented out at its full capacity or close to it, 85% or higher, you should be fine. But COVID was a nasty hit for everyone. So what I've learned is that we've all just had to fight through it, because the guidelines did not change because of COVID. The guidelines still stayed the same.
Yes.
So if you had to make money consistently.
Yes. And sometimes don't you take a little leniency? At least some lenders, banks do, if they can explain that it was COVID, but they learned how to pivot and they've gotten it together. Do you do that?
If we shown that you were able to reinvent yourself and become to think out of the box to still bring in more income doing other things, then yeah, we definitely want to look at that. We want to see that you're not your typical man. If I don't have this money coming down, I don't know what I'm going to do. Well, other people may start doing Airbnb or something like that. Yeah. Well, that's going to say, okay, well, hey, this person thought out of the box and he ended up starting making money off of this Airbnb. Mm-hmm. So, and that's what a lot of my investors did do that were doing long-term rentals. They converted to Airbnbs and short-term rentals. So,
which is awesome.
Exactly. Yes. I mean, there's just so many ways to skin a cat. It's just a matter of you having the means to do it, or thinking about the ways to do it, should I say. And that's really what matters.
Yes.
So there's more than one way.
That's right.
Skin a cat.
Hey.
So you have to be creative, and that's very important.
Yes. And you don't have to talk about debt service because we've talked about it extensively, but that's something that you as a lender would be looking at, right? When you're looking at these documents for a business that a buyer is purchasing, if they're going to be operating the same business, you want to know that what income, right? What net income, which we all know is the gross subtract the expenses now, right? If we didn't before, that business has been bringing in. And so that's the high likelihood, especially if that buyer right, doesn't own that similar business themselves. On another hand, right, they're buying maybe a car wash and they haven't owned a car wash. So you're looking at the seller's net, that
Exactly.
right, and
Right.
yes, their net operating income, or NOI. Throwing
Yes.
out all these terms for you guys here, okay? And you're trying to make sure that the buyer will be able to service the debt and do debt service. So we talked about that. So the last thing we want to talk about is something that doesn't always happen, right? And we're coming up here on the end of our show. It's been a fun time, but talking about environmental inspections.
The EPA.
Woo! Yes, it's a fun times, right? Let's talk a
Ooh,
little bit about
yes.
what an environmental inspection is and why would a buyer need to have one.
Okay, it depends on the type of business that you have. So let's say you've got again, let's use an apartment complex again. You're going to need an environmental one there, but that one is not going to be nowhere near as bad as if you had a mechanic shop. Okay, if you're working on cars, because you're dealing with oils, then you're dealing with a lot of fluids that that can damage the ground, and so they're going to want a very detailed environmental inspection when you're looking at something like a car dealership or a car repair shop compared to a apartment complex. Apartment complex, most of your environmental reports will run you somewhere around $1,500, something like that. If you're the more you have to deal with chemicals and the actual environment itself, the more extensive the report can be, and also the more expensive it can be. So, I say stay away from the chemicals.
If you can.
If you
If
can,
you
yes.
can,
Your
yes.
estimate, maybe go towards that, where you have to, so to the mechanic, they have to have that, so expect to spend about $5,000-6,000 on an environmental report, if not more.
Yes,
Yeah.
yes,
You
And
you
have
if
to-
it's not good results, you have to clean up the
Yes,
property.
yes.
And that can be expensive.
if you're buying it, then you don't have to do it. But the seller would have to do in order for them to sell that property. But
The seller's responsibility.
well, yeah, because you don't own that property. The buyer, he's getting the environmental inspection to buy that property, but the seller owns it. So if the seller did not maintain the property, let's say they were throwing the grease out or oils in the backyard or whatever, well, you now damaged and all that land down there, go back there now, so they can get into the water wells and stuff like that. So we can. That's why they do that. They make sure that the grounds that surrounds that particular business are not contaminated or anything that can hurt the environment or the people that are around it.
Yes, now
Yes, really, that's very important.
it is.
Yes.
It's important. And sometimes sellers, they may be difficult. Have you ever had a situation in your experience, Rod, right, where the buyer went ahead and paid for, that environmental cleanup because the property is being sold as is, like many commercial properties, and maybe the seller doesn't want to do that? Have you ever had that, or is
The
that very
times I've
rare?
had it, the buyer walked because he couldn't get his license. He couldn't be able to do his business. So if they're saying the grounds are contaminated, no one's going to give you your license to be able to run your business. So it wouldn't be a
That's
smart
right.
move.
Yes, right. And so my question was, has the buyer ever paid for it themselves because they just really wanted the property?
But
Have you ever seen that?
never have I ever seen that, because you're
Because
paying
it's
for
not yours yet, right? So
exactly.
why would you?
Somebody else's
Yeah,
business.
sometimes we ask the questions and we know we just want you to say. So so nonetheless, thank you so much,
Yeah, thank you
Roderick.
for cleaning up my property. and
Yes,
selling
Yeah,
it.
exactly.
No, you're not going to do that. So, and there's different phases for environmental inspections, right? Phase 1, phase 2, and
Yes,
so
exactly.
forth, and if you ever are in need of that, of course, we will walk you through step by step. And of course, hey, we've been talking about from the
lender, yes.
the buyer's point of view. Right? The lender will walk you through and we'll help guide you. But we've been talking about the buyer's point of view. The Turner Team Realtors, we work with sellers of commercial property and buyers of commercial property, and of course, residential as well, and investors. And if you need to lease commercial property, we'll have a webinar all about leasing sometime soon too. So thank you so much, Roderick, for your time tonight. This has been awesome. We have really enjoyed our conversation.
It's
Thank you.
almost like a whole course
I know.
on commercial loans. And then you went through the review.
Yes.
And then you went through the finals.
Yes, yes.
I
Awesome.
give him an A++.
I-
A++. Thank you so
Thank you
much,
again.
Roderick.
Thank you. I want to say, folks, definitely call the Turner team. You cannot get a better group of ladies to help you to accomplish your goal with buying a house or getting a business, whatever you wish to do. You got the right team right there. That's the Turner team, and I make darn sure that we make them look good, because if we don't, you won't come back to us. We want you to
Hey,
come back.
come on now.
We can tell your
That's
friends
right.
and family
Thank
members and
you.
your cousins and everybody about us. Okay, so
Yes.
Yeah, we work together so we can all look good.
That's right. And thank you
And
so
thank
much,
you.
Roderick. That is so kind of you. And you know, Roderick is awesome. You know, Roderick Nash, the CEO, senior mortgage banker of Rockgate Financial Services.
There we go.
All right. And we will connect you with Roderick Nash. If you haven't done so already, make sure you register so you're staying abreast of what's going on. And like our Facebook page, follow us, and what subscribe. That's right. Subscribe to our YouTube channel, and we're sure to be in touch. Now, hey everyone, we have a really exciting event happening, and Roderick is part of it.
Yes.
This weekend. This weekend, we are going to be having the Turner team host the free community shredder event, and Roderick Nash is our special guest. We're so excited to enjoy this day, this afternoon. I'm trying to make it large for you there. Yes, this afternoon, morning and afternoon, where you can bring your paper documents. Maybe you have some personal, some private or business documents that you need to shred safely
Yes.
and on site.
That's right.
You can come right on out to 14700 New Halls Ferry Road in Florissant, Missouri. And that is the Friendly Temple. One of our co-sponsors is Friendly Temple. They have donated the space so that we can have the community come on out. And our other two co-sponsors are none other than Roderick Nash on his residential side with Guild Mortgage. And you can look at his previous video as it relates to residential real estate on the Turner team page, as well as First Mid Bank and Trust, which will be representing the commercial side for that day. So we're really excited about it. We're going to have a great time with one another. So come on out. Of course, it's Saturday, May 13th, 11 a.m. until 2 p.m. Okay.
Rain, sleet, or snow.
Yes. And we're
That's
praying for sunshine, blue
Sunshiny
skies.
day, honey.
I'll do a rain dance for everybody.
Yes, we did that for our yard sale, so it worked then, so
it'll work now.
It'll work again.
Yes, that's what we're hoping and praying for. And you know, last but certainly not least, we want to make sure that you know that we are providing the best information for you, our viewers. However, of course, there is a disclaimer. If you have any professional advice as it relates to taxes, legal advice, and other advice that's not related to real estate as a realtor or as a lender, make sure you contact the correct professional for that information. We are not giving legal advice or tax advice or any other type of advice tonight.
Other than
real estate as a realtor
loans,
and a
commercial.
lender as a commercial lender
Yeah.
for loans. All right. So thank you again, Roderick. We're
Thank
looking
you too,
forward to
lady.
the next time.
Yes.
Thank you very
Thanks
much.
again.
All right. We'll talk to you soon. Take
Bye-bye.
care. Thank you,
Bye.
viewers, for tuning
We'll see
in.
you
Thank you,
Saturday.
guys. Thank you for tuning in, and look forward to seeing you guys again.
Yes. See everyone on Saturday. Come on out. Bye.